Hey everyone, welcome back to Corporate Decoder. Today, StepStone Private Venture and Growth Fund just filed an N-2 registration statement, and I'm seeing a huge expansion on their registered shares. Quick note, this is not financial advice, just my take on public filings for educational purposes. They are looking to raise another $10 billion, which tells us they are seeing a lot of opportunity in their market. So StepStone Private Venture and Growth Fund, a closed-end investment company, is essentially doubling down on its strategy to invest in the innovation economy. This means they are looking for cutting-edge companies, technologies, and sectors that are poised for growth. Their main goal is long-term capital appreciation achieved through venture capital and growth equity investments. This isn't your typical stock market play. They are targeting private companies, which means they are investing in businesses before they become public. They offer 3 classes of shares: Class S, Class D, and Class I. Each has different investment minimums and fee structures. Class iShares, for instance, have no upfront selling commissions but require $1 million minimum investment. That is a pretty high bar. Now let's look at the money side. Class S shares come with a sales load of up to 3.5%. Class D shares have a smaller load of up to 1.5%. Class iShares have no load at all. This is pretty standard for tiered share classes, designed to cater to different investor needs and broker compensation structures. Their investment objective is clear long-term capital appreciation by focusing on the innovation economy and companies that benefit from attractive secular trends. What does that mean? In simple terms, they want to invest in companies that are part of major shifts like digital integration, cloud computing, and blockchain technologies. The fund is concentrated in the information technology sector, but it diversifies across various industries, including enterprise, consumer internet, healthcare, and branded consumer goods. This sector concentration means that if the tech industry booms, they stand to do well, but if it struggles, their performance could be more volatile. They are actively looking at companies and technologies that are disrupting traditional markets and benefiting from long-term trends. This is a high-risk, high-reward strategy common in venture capital. A key part of their strategy is to invest at least 80% of their net assets in these venture and growth assets. This shows a strong commitment to their core investment focus. Looking at their asset allocation targets, a significant portion, 50 to 70%, is earmarked for secondary investments. This means they are buying existing stakes in companies or funds. This can help mitigate the J-curve effect, a common challenge in venture capital, where early investments often show negative returns. And within those secondary investments, 60 to 75% will be in venture capital, with the rest in growth equity. This allocation shows a clear emphasis on early to mid-stage growth companies. Geographically, they are heavily focused on North America. 70 to 90% of their investments will be here, with smaller allocations to Europe. And the rest of the world, this focus on North America makes sense, given the concentration of tech and venture capital activity in the region. This fund isn't operating in a vacuum. StepStone advises multiple clients and funds with similar investment strategies. This brings up potential conflicts of interest, especially when there are limited investment opportunities. The filing mentions a strict allocation policy designed to ensure fair and equitable treatment for all clients. So this is crucial for maintaining investor trust. They are also using leverage, a credit facility that allows them to borrow money. This can amplify returns, but also magnifies losses, a classic double-edged sword for investors. Now let's talk risks. Investing in private markets like this comes with its own set of challenges. Valuing these private investments is tricky because there isn't a constant market price for them. The fund relies on valuations provided by the investment managers themselves, which introduces a degree of subjectivity and potential conflict of interest. The net asset value, or NAV, that they report monthly is based on quarterly valuations that can be 45 to 60 days old. This means the reported NAV might not fully reflect recent market changes. This delay in information is a significant risk factor for investors. And then there is the illiquidity issue. Private market assets aren't easily bought or sold like stocks. This means investors should be prepared to lock up their money for an extended period, potentially years. Remember that concentration in information technology I mentioned earlier. This is a significant risk factor. If the tech sector faces a downturn, the fund's performance will be heavily impacted. This is a point that investors absolutely need to understand. Let's look at the fees. This is where things can get really interesting for investors. The fee table shows various expenses for Class S, Class D, and Class I shares. Class S shares have a maximum sales load of 3.5%, Class D shares have up to 1.5%, and Class I shares have none. When you add up all the annual fund operating expenses, you are looking at about 5.4% for Class S shares, 4.8% for Class D, and 4.55% for Class I. This is quite high compared to traditional mutual funds, but typical for private market funds. The incentive fee alone is estimated at 2.27%, which can really eat into returns if the fund performs well. The example shows that on a $1,000 investment, Class S holders could see $87 in expenses after 1 year, Class D holders $62 and Class I holders $46. Over 10 years, these costs become much more significant for Class S at $546. This highlights how important those fees are for your long-term returns. Now, who is running the show StepStone Private Wealth LLC is the investment advisor and StepStone Group LP is the sub-advisor together. They are responsible for managing the fund. They have a ton of experience in private markets, overseeing hundreds of billions of dollars in assets. Bob Long, the CEO of StepStone Private Wealth, has 3 decades of experience in private markets and has led several major financial entities. He is a well-regarded figure in the industry. Tom Sitmar, the executive chairman, brings 4 decades of capital markets experience and has led major asset management firms. He brings a wealth of knowledge to the table. The Statement of Additional Information, or SI, provides more detail, but for our purposes, the prospectus gives us the key takeaways. This filing shows they are confident about the future and are raising significant capital to pursue their strategy. The risks are clearly laid out. Private market assets are inherently volatile, and their value can swing dramatically. This isn't for the faint of heart. The fund itself has a limited history, which means investors are largely betting on the team's past performance and their ability to execute their strategy. The same goes for many of the underlying investments they make. This is a crucial point for potential investors. The fund is a closed-end fund, and there is no secondary market for its shares. This means you can't easily sell your shares when you want to. You are locked in unless the fund offers a repurchase program, which isn't guaranteed. The allocation policy is important. They're saying they have a fair system for deciding which client gets what investment when opportunities are limited. This is key to preventing insider advantage scenarios. So what is my take on this filing? StepStone is doubling down on its strategy to access the innovation economy through private market investments. They are raising a massive amount of capital, $10 billion, which signals strong conviction in their ability to find and manage these deals. The high fees and illiquidity are significant risks. Investors need to be fully aware of this. Is definitely a long-term play for sophisticated investors who understand the risks involved. The direction of the company seems to be expansion and a deep commitment to their private market investment strategy. The risk I am watching is whether the current market conditions will continue to favor private market investments, and if they can successfully deploy this massive amount of capital into promising ventures without dilution impacting existing shareholders. Elders Too Much O and the research tools I actually use are linked in the description. They help keep this channel going. That is my take. Stay decoded. Like, comment, and subscribe for more insights, and check out the Discord in the description below.